I guess I wanted to talk to you about, I think we talked about maybe this kind of, we have this portfolio we call the buy and pullback portfolio at Geo. Again, I'm Maj Soueidan from co-founder of GeoInvesting, and we cover this, microcap and nanocap space, and also we also look at potentially fraudulent companies here and there too along the way, but mainly we're concentrating on looking for bullish opportunities. And along the way, I'm helping our members understand some of the risks involved in of maybe not so great companies out there too. So we do a little of both. We call that portfolio protection. You have our disclaimer here. I'll show it here in the slide, Nathan. You can also go to our website, GeoInvestingcom, to view the disclaimer, and I highly encourage you to do that as we move on here. So, so the buy and pullback portfolio is one of our model portfolios we created. I think it was 2015, end of 2015. I think that's when the oil crisis was going on. And we had we founded GeoInvesting in 2007, and we had been around for a while, and we had a lot of stocks in our model on our long disclosed screens that we had, and we figured we should probably break those up into different types of portfolios to help our members understand the conviction and the types of calls that actually we were making within our website. So one of the ones that came up was the buy and pullback, which is kind of to take advantage of misunderstood situations in the market. So, and it's really, although we're longer term investors, we introduce this maybe of a shorter to medium term type of model portfolio. And it consists of maybe anywhere from 5 to 7 or 8 stocks at a time. And the goal really is to disconnect some prices because of market turbulence or because of misunderstood information that causes stock price to go down. But also in situations where, especially in nanocap land, where even if there's good news, there's no movement in the stock, to give us a chance to get in and really get some cheap prices with public information out there that really no one's even paying attention to. And the returns of those have been pretty good for us over time. And I didn't make a presentation on that, but I want to kind of bring that up if I can here. Hold on a second here. So we've had sorry
to cut you. I was going to say let's talk about that afterwards, because you have it's an interesting time in markets and you had some views on that. So yeah, let's do that afterwards. Yeah, carry on.
Yeah. So what we'll do here is I'll talk through this particular stock here is a company that it's a software company, or it's actually an IT software kind of labor company. It's called Information Analysis Incorporated on the OTC, and this falls into that category of just a quiet little nanocap company running sitting around that no one's really noticed that much, despite some really kind of inflection point type of developments that are taking place in the company. So if we move, I'll just go through the presentation real quick here. So the company was founded in 1979. They use software, mainly third-party software, and their own programmers to kind of modernize IT systems, mainly for the government really right now, although they are doing some commercial stuff. So, and why is that important? So if you look at the really summary of the bullish thesis here, after years of this company kind of meandering around and not doing much in terms of growth, they just received a new contract recently. That's going to a 7-year contract, $25 million contract on a modernization program within the government. They hadn't really say what branch it was yet, but they help at the federal, even state and local level. That's where they get their contracts. And there's a lot of operating leverage in the business where revenues grow, earnings per share will grow a lot, significantly more than sales. Trading only a meager 0.5 times sales. And I think that once investors start to see what's going on here with this company, where you've taken this is a typical nanocap story where you have a sleepy stock here that people who know the stock first get into the stock because they've been following it as we have for several years. And then eventually new investors come in once the company has proven that they have turned the corner. So we think we're here, the stock's sitting at 70 cents or 65 cents. And we think, we're at that tipping point. So this defines what we like to call a tier 1 quality company. Before I get more into the thesis here, and I'll go over that. And we have like a 10-point, questions that we ask to determine if it's a tier 1 company, OTC company. And this meets all of them. Long-term operating history of at least 20 years. This has been around for 40 years. Strong management, yes. The management has been here for, from the beginning, since 1979. And they've been sticking around even through, the good and bad times. And we like these kind of old management teams, old school teams that have been around for a long, long time, that have proven that they can, even if they're not growing, keep the company afloat and just be ready for when a catalyst occurs. And that catalyst has occurred, in our opinion. So we're excited to see that. We like management teams that are focused on the business, not the stock price. This company barely puts out any press releases. Really is not promotional at all. Has revenue, as is at or near profitability. And the situation, this company meets both of those. We believe it's a high probability turnaround story. We love those kind of stories, basically because the company's been around for a long time, has worked with the government for several years and on many contracts. So it has a reputation to believe that they can execute. High insider ownership, 51%. They have zero debt. And we love that we really stick with about capital structure and the company's being able to grow without having to raise money through the equity markets excessively. And these guys have not done that. And they have only 11.2 million outstanding shares. I just can give you some full disclosure. I originally bought the stock in 2018 after watching it for a while. And I bought it at 47 cents, actually. The stock got as low as 8 cents, though, because basically the inflection points I thought was going to occur just didn't occur quite when I thought it was. And I'm going to get into that a little bit in a second. So it's basically what had happened there was they won this contract back in the day. I mean, I think it was when I first got involved or was getting involved in it. And the incumbent company that was awarded that contract before protested IAIC's award of the contract. So that was when I got into the stock, I didn't know obviously that contesting was going to happen, and that's why the stock went down, and it delayed a lot of some of the growth the company had expected to happen for that until now. So the if we look at some of the again here they have it's trading at 66 cents. Has $1 million in cash, zero long-term debt, decent current ratio of 2.3. So it's not excessively over. Valuation isn't excessive, and we'll talk about the low gross margins in a second. 11.4%, and there's some upside there too. You look at the stock here; it's underperformed for years. This is a typical chart I like actually in these kind of sleepy old nanocap companies. That find a way to come back from the dead. And the stock was as high as like 25, 30 bucks back in the day. And when software companies and .com was going on and everything was going up, and then all that bubble burst, and we know what happened from there. This shows you how sleepy it's been. This slide here, really revenues of meander between 7 and 10 million. We perked up a little bit recently, but as you can see, though, it's kind of been around break even or profitable. So even though they weren't growing much, they were at least able to maintain profitability, which is part of what I talked about earlier. So the inflection point event we just talked about, this $25 million Modernization Award, which will be for 7 years. So this is going to give certainty to the story, where now we can definitely say this company is going to be consistently have a nice base of revenue, give them the cash to start pursuing other growth opportunities, maybe even outside the government. So it really puts them with a great base. And they already have like a base of, I think, maybe 3 million to work off of. This whole thing works out to about $3.5 million a year. So you're already seeing an uptick in the revenue just on the old revenue plus the new revenue if they do nothing at all. So why is this a problem? So if you look at the industry that we're dealing with here in terms of the government, outdated IT systems. So basically, if you look at some information, some stats here, the government spends over $300 million a year to maintain outdated IT equipment, which I thought was very surprising. And there's in all, there's 10 critical IT systems in the government that are outdated, ranging from 40 to 57 years. So that's, and some of these are in the national security, which I found, ridiculous. So I think, we're kind of, have we reached that tipping point? I think we're getting close. And I think actually COVID-19 has kind of exposed some of the weaknesses in some of our infrastructure and, database in the government, whether it's from the getting out the loans, unemployment checks. It was really a mess. And we're just living in a different world now, where I think that protectionism, where the budget's going to start loosening up for spending the money on new technology. And one of these things is these all systems are running on old programming technology called COBOL, and it's hard to find those programmers. And IAIC is basically well equipped with those types of programmers to address that problem, and which gives them a little bit of a competitive advantage too, I think, in this market, which can be quite competitive. So, that's really the crux of it here. I mean, you have a situation where it's really a simple story, Nate. I mean, and I like these really simple stories. And where's really a big upside here? And I always try to find that one piece of the story that's really nice. So it's great they got a contract, but it's great they've been around for a long time. And what is really going to make this thing turn this thing into a multi-bagger potentially? Convinced that we found the stock early before a multi-bagger move. And that really has to do with the margin. So as I mentioned earlier, that the margins were pretty weak earlier, around 11%. And they have two pieces of revenue. One is the third-party software revenue, and one is this professional revenue. So the software revenue is basically, from what I gather here and talking to the company, most of it's from using other company software like Oracle maybe, and when they win a contract. And then where they really make their money is on the professional revenue, where they have their programmers and project managers go in to a project and implement everything. And that's key. And that's currently was 35% of revenue as of recently. So I think this is as of the Q3, but it's been higher in the past, significantly higher. So I'm sorry, ma'am. I mean, it's 20% of revenue right now. So software revenue is 80% with 1.5% margins. Professional revenue is 20% of revenue with 35% margins. So you can see that now. There was a time when the professional revenue was more than the software revenue. It started to decline recently in a few years because they weren't getting a lot of new contracts, and a lot of these new contracts have a lot of the professional revenue is uploaded in the front. So now with this new contract, and from a little due diligence, it appears that a lot of it, and maybe most of it, a good deal of it's going to be professional revenue. So now we just have this double whammy situation where we're going to have increasing revenue and probably a higher contribution on that revenue going to higher margin revenue. So if you look at, let me see if I can, so the operating leverage. So for example, this is all part of the whole margin kind of catalyst I'm looking for here. So Q2 sales were up 20%, while operating rate expenses were down 30%. So they're going to possibly get this double whammy thing where you have a better gross margin, hopefully coming through through the revenue line, and then continue to maintain the current or even maybe decrease operating margins, which gives a double whammy upside on the income. So valuing this company is tough because what do I do? It's so early in this recovery for the company. I just think it can be a lot higher and from now in future years, and it's selling at a reasonable valuation where there's not much risk in the company, buying the company. If you do some math and we came into and we wanted to use like a PE approach on earnings per share based on the current backlog of business, we get about $1.50 and a 15 cents earnings per share potential in the short term. So I think that's a reasonable type of valuation to put in the company right now. And given there's a lot more upside of a lot of other catalysts, and there's other catalysts could be they go into commercial markets potentially. Obviously, now that they have momentum, get some more contracts to go after. Maybe they develop their own software, which is something I brought up with the company, and they didn't say no. Imagine if that was the case, you're going to take that, 1% software revenue, and you're going to get probably into the 50, 60, 70, 80% margins maybe on that revenue if they were able to do that. So I'm trying to dig into that a little bit too. So I like these situations where there's a great, in my opinion, a great reason to buy the company as is what's going on now, based on current developments, but there's so many other catalysts that could really take it to a lot higher level over time. And that's what really has me excited on this one. And this is very typical of a kind of stock we look for in GeoInvesting.
Very cool. Thanks so much. I noticed here, you mentioned something on August 17th, and looking at the price chart, this was down in the doldrums, as you mentioned, sub 20 cents a share until August 17th. Was it your letter or whatever, your thing that prompted that?
Yeah, we brought it to our, members' attention. We have a premium portal, and we not bragging or anything. We just found the information. But it was interesting on this on this one, Nate, was, as I said earlier, these guys aren't promotional, and we found the verbiage that they were going to get. They won this contract. Well, actually, the incumbent withdrew their protest on the contract. It was in their Q2 filing, and they didn't put a press release on it. And then what was really interesting is I unfortunately didn't do the same analysis on Q1. And in Q1, they actually was when they first announced that the incumbent withdrew the protest. The stock was sitting like 8-9 cents back then. It had not moved much since then. And it wasn't until we kind of found it in Q2, talked about it, that the stock started going up. And then a few days later after that happened, the company actually issued their Q2 earnings, I believe, or their Q2 press release. A few days after the Q2 was filing. So I don't know if it was us talking about it with the stock going up that made them put out that press release, but I still think there's upside for me. I mean, I've bought stock as low as, 10, 15, 20 cents. I bought it originally in the 40 cents. I've paid as much as 65 cents, 60 cents for it. So I've been even on the upside, on the way up, I've been buying it. So
nice. And you say that you think it's valued at about $1 and change. What was that? $1.50?
Well, I think based on the current kind of, you're looking at taking into account that the revenue is going to be more professional revenue, a higher margin revenue, assuming that the OPEX is going to stay flat or not really rise much from current levels, and take into account some of the backlog they kind of talk about. You can work that backlog and kind of figure out what their legacy business is doing for the next year or so. Putting that all together, we come up with a valuation of about $1.50 based on what they can do.
So it's upside of another 150%.
Yeah, just on re-rating, even price of sales, you get there too, because we think this, so some people will say, well, look, I mean, it's, this is a government business, it shouldn't get a really decent multiple. It should trade below 1x sales, but I think that's the wrong way of looking at it, because we have a situation, we have 7 years of consistent profitable revenue to grow off of. And this hasn't been part of that story for a long time. And that consistency means something. And I have all the confidence these guys are going to find a way to find maybe higher, maybe more sexier revenue that eventually the market will want to place a higher multiple on. And you got to give them credit for hanging around for so long here, and waiting for something like this to happen. And even with COVID-19, I don't like to do this COVID-19 play, but it has a little bit of, it's rushing, it's expediting the need to do address some of the problems that this company solves.
Right on. All right, cool. Mentioning COVID-19, and you had some timely views on this pullback portfolio, which, by the way, sounds vaguely sexual. Oh no, that's pull out. Sorry.
We've all been there.
Yeah, so talk to me about where you see the New York markets today, because there's some talk about this already being a rotation out of tech. We've seen some of the benefits, some of the stocks that have benefited the most from this, stay at home, work at home. The Pelotons and Zooms of the world have sold off pretty dramatically over the last couple of days. Granted, they were arguably overbought. Definitely overbought, one could say. But what do you make of all this rotation and the Pfizer with this potential virus and everything else that's going on? And where does it? What kind of stuff are you looking to do now in the portfolio?
Besides digging my portfolio yesterday, I took a pretty big hit yesterday.
Oh, well, okay.
It was very interesting. And like, I think we don't look at timing markets. We'd like to understand what's going on, obviously, and how it can affect if these new developments will positively or negatively affect the positions we're in. But we're still looking at really where were the overreactions yesterday. That's what we were looking at. And that's what our buy and pullback portfolio really does. It kind of looks for these overreactions. And it just happens to be that the COVID-19 is a theme right now where there's a lot of overreaction on both sides, in terms of price movement. And so we've launched 8 of these portfolios already. And, the average return on these 8 portfolios has been about, 55%. And they're meant to be, shorter term, but they range anywhere from 6 months to 2-year portfolios, depending on the kind of theme we're looking at. And they've beaten the S&P by an average of 14.7%. Our last one was actually which was also a COVID theme. So earlier this year, we looked at these value stocks that were all getting beat up, right? That were kind of getting punished from their financials because of COVID-19. So a lot of them fell. We created a portfolio of several stocks that we thought fell way too much. And in 6 months, that portfolio was up, I think, like maybe I'm looking at 74% or whatever. And so we're doing that again, so COVID is in the news again, and it's caused this rotation and some of these stocks to fall. And now what we're doing is there's an assumption because of the vaccine that some stocks that where their growth was benefiting from COVID-19, addressing some of the issues that it created, that they're going to see an abatement of their growth, right? And that may be true for a lot of, for certain themes, but what we try to do is, where are the few companies here that are going to actually, who are already benefiting from kind of addressing some of the issues and are going to continue to benefit from that.
All right.
And so part of our current number 9 portfolio, which we just launched, includes some of that theme because of yesterday. Just happened opportunely that happened.
Yeah.
We currently have 4 stocks in there now. We just launched on October 31st. It's already up. I mean, I think like 10%. And we added 1 stock yesterday, and we're going to add about 3 or 4 more.
Can you share where these stocks are?
Not quite yet. I don't want to do that just quite yet. Yeah.
All right. But your subscribers get it, right?
One yesterday was Obci. I'll do that.
Okay.
Ocean Bio-Chem. And so this was a typical situation where this is actually they're actually based here in Florida, in Fort Lauderdale near me here. And I get to visit them once in a while. And it's been a boring stock. And they basically are been around for a long time. Their claim to fame really is creating boating kind of products, maintenance products, fuel additive products for the boating and the RV industry. And they have a very stable kind of business, and they have complete distribution, in the supply, in the whole market. Not really a fast growing market, but they had this other little product they tried to develop. They did develop, called Performance Side. And during the Ebola outbreak, remember that?
Yeah, of course.
And at that time, they really hyped the product up and thought it was going to be their next really new growth kind of catalyst for them, because they have great distribution already. So they're just going to put that into their distribution network. But Ebola was short-lived, didn't last. So this disinfecting, it didn't get anything. So then COVID-19 comes along, obviously, and it's more. This, by the way, this is more of a commercial grade product. It's not really that great on a consumer level. It's not practical for certain reasons. But so now, you have the situation where, okay, the stock, I think the stock went from $6 to like, we bought it around $7 or $8, and along with our members, stock got as high as $20. Now it's back to 12, 13. It was down $4 yesterday, I believe, or almost $4 yesterday, based on this whole vaccine news, because of the, hey, it had that COVID-19 run with the disinfectant, sanitization product. But what people don't realize is that they're selling to the commercial markets. So So as the economy opens, that business is going to get stronger because they're going to continue selling to the commercial market. And their boating business is also getting a boost because of COVID. And we think that's going to continue as an activity, right? That what people want to do right now. And that theme we think is going to continue to get better too. So you're going to have both of these trends that were helping them during COVID to some degree are, I think, going to accelerate for them moving forward. And I don't have the valuation here in front of me, but it's pretty compelling. I think they did maybe 50 cents a share, or let me see what you got that in front of you. Nathaniel?
EPS is 62 cents.
Yeah, and that was in Q2, I think, right? And they've already projected some really good numbers for Q3. And this company's management, part of what nanocap space too is kind of reading these management teams and how they talk to you, how they put out press releases. Are they getting more optimistic? Because these guys were usually this kind of very kind of cautiously optimistic type of phrases and kind of persona. And they've been unusually bullish here last couple of press releases. So I thought, and they're talking about having long-term visibility and long-term trends. They just expanded their manufacturing facility recently, all to take advantage of this whole kind of sanitization side of their business.
Interesting. Yeah,
it's a clean company. It's a real clean balance sheet. I mean, it's really, really interesting company actually. Yeah. I didn't love this thing because there was times in the past when they would overpromise, underdeliver. But I got to hand it to them. They just said wait around and we'll get this right. And I mean, opportunistically, whether you want to call it that or not, COVID-19 happened, and they're able to kind of, they're definitely showing that they can sell this product and they can sell a lot of it.
Yeah. OBCI is the ticker, by the way. O like Oscar, B like Bravo, C like Charlie, I like India. Interesting chart here. The stock is up almost 3x on the year, up 280%. But then over the last 6 months, it's up 80%. Over the last month, it's down 18%. And this week, it's down 20%. So, pretty dramatic sell-off.
I think what you have here, Nathaniel, you have a lot of these investors that are investing in some of these COVID-19 themed stocks, and they don't understand what they're investing in.
Right.
And they're not really looking at the company.
Right.
And it was plain as day that this company is going to benefit post COVID-19. And we don't like investing in COVID-19 type of stocks. We like investing in businesses that can grow through these crises. And in this case, it just happens to be that they're probably better positioned than they were before because of what's going on.
Right. Cool. It is up $1 a share, $1 today, up 8 cents, but still, well below its 52, its all-time high, which was right around $20. It looks like, and they also pay out a dividend.
Yeah, special dividends here and there. Yeah.
Well, 60 basis point yield, but still better than nothing. Cool. All right. I don't see any questions in the hopper, so I guess we'll take this opportunity to close. In closing, please do sign up for the premium subscription, contrarian.supercast.tech, TECH. Maj, how do people get onto your thing? It's GeoInvesting.com. Is that it?
Yeah, GeoInvesting.com.
Right.
We have you can reach me at Maj at GeoInvesting.com. Also at Twitter at Maj GeoInvesting. And so we have membership based. We have a monthly membership option. I think it's like $60 a month. We have a biannual option, which is about $300 a month, and then we have an annual option, which is about $480 a month.
Nice.
I'm sorry, year. Those are years, by the way. $300 a year, $300 for 6 months, and $480 for a year.
Nice. I was going to say that's a little more than what I charge per month, but actually per year it may average out. But you also get a lot more. Well, maybe not with your thing. I get your thing, and it's very insightful stuff that comes.
A lot of content for sure. I mean,
ton of content. It's great. Yeah. All right, cool. All right, thank you everybody so much, and we look forward to speaking to you all again next time.
Thanks, Nate.
Thanks, Ann.